to power their next massive AI cluster, OpenAI isn't just like buying individual chips from AMD. They are actually signing a deal that requires 6 gigawatts of electricity.
Right, which is just an unbelievable number.
It is. I mean, to put that into perspective for you, that is the equivalent power output of 6 standard nuclear reactors.
Oh, wow. Yeah.
All of that dedicated to a single customer's computing infrastructure.
I mean, we're no longer just looking at a semiconductor company here.
No, definitely not.
We're essentially watching the rewiring of the global electrical grid right in real time. So welcome to a special TalkTickers edition of the Deep Dive.
Glad to be here.
Today, we are tearing into advanced micro devices, specifically their Q4 and full year 2025 earnings call.
Yep, the one with CEO Lisa Su and CFO Jean Hu.
Exactly. And what Lisa Su is calling the start of a multi-year demand supercycle.
And that 6 gigawatt figure you mentioned, I mean, it completely changes the framing of this entire company.
Right. It's a whole new ballgame. Because for years, the conversation around AMD has been heavily focused on market share battles with Intel in PCs.
Or just chasing NVIDIA's tail in raw GPU compute.
Right. Exactly. But the sheer scale of the infrastructure they are deploying now, it suggests we've moved past that phase of just, comparing teraflops on a spec sheet.
Yeah, we are looking at a company trying to become an end-to-end provider for the most energy-dense data centers in human history.
Which is wild.
It is wild. And as retail investors, if you're holding or considering this stock, that means our analysis really has to evolve too.
We definitely can't just look at the top line beat or miss anymore.
No, exactly. So today, our mission for this deep dive is to really hit the headline numbers first. We want to unpack the story behind those numbers.
Right. Look at the underlying financials.
Yeah, see if the operating leverage actually supports this massive scale. Then we are taking a hard look at the data center dynamics.
Specifically, why the x86 CPU is having this huge renaissance alongside the AI GPUs.
Right. And we'll also dig into the localized AI push in the commercial client sector, navigate the rather brutal headwind in their gaming division.
Yeah, that gaming division is rough right now.
It really is. And then we'll finish with an actionable, highly opinionated bottom line on what this means for you, the investor, based on management's forward guidance.
Sounds like a solid roadmap. The overarching theme of this earnings call really was execution at scale.
So let's start with the baseline financial health to see if the numbers actually validate that.
Let's do it.
Because the fourth quarter of 2025, it painted a very robust picture on the surface.
Oh, absolutely. The total revenue hit a record $10.3 billion.
Which is what, a 34% year-over-year increase?
Yep, 34%. Yeah. And net income surged 42% to a record $2.5 billion.
That's huge.
And they nearly doubled their free cash flow, hitting a record $2.1 billion.
Okay, let's unpack this for a second. Because those are massive figures for a company operating at a $10 billion quarterly run rate.
Right. You don't usually see that kind of growth at that size.
Squeezing out 34% top-line growth at that scale requires firing on literally multiple cylinders simultaneously.
It really does.
But the metric that really jumped out to me in the Q4 print was the gross margin.
Ah, yeah, the famous gross margin.
Because they reported a Q4 gross margin of 57%. Now, 57% gross margin for a fabless hardware manufacturer is elite territory.
It is.
But CFO Jean Hu explicitly noted that this figure included a $360 million inventory reserve release, and that was tied to their older MI308 products.
Right, and Jean Hu made the right call by highlighting that up front.
Because relying on accounting magic to juice your margin profile is a red flag, right?
Absolutely. It's a huge red flag for any serious investor. Because in the semiconductor industry, product cycles move incredibly fast.
Yeah, blink and you miss it.
Exactly. So if you manufacture a batch of AI accelerators, in this case the MI308s, and suddenly demand shifts or, regulatory export rules lock you out of a specific market,
you might just have to write down the value of that inventory.
Right. You take the financial hit in a prior quarter, essentially telling the street that this silicon is dead weight.
But, and this is the fascinating part, the AI hardware market in 2025 was so severely supply constrained that AMD actually found buyers for those older chips in Q4.
Yeah, people were desperate for compute.
Exactly.
Yeah.
And because they had already taken the cost penalty on the balance sheet previously, the revenue from selling them in this quarter flowed through as essentially pure profit.
Which is what artificially boosted that headline gross margin to 57%.
Right. It makes the current manufacturing efficiency look slightly better than reality.
It does, which is exactly why the organic gross margin is the real signal we need to track here.
So break that down for us. What is the organic margin?
Well, if you strip out that $360 million reserve release and exclude some specific China-related revenue that we'll touch on later, the organic gross margin settles at 55%.
Okay, 55%.
And here is the critical takeaway for you as an investor. 55% is still up 80 basis points year over year.
Wait, really? Even without the accounting boost?
Yes. Expanding organic margins by almost a full percent at this scale proves their product mix strategy is working perfectly.
That's a very strong signal.
It is. They are successfully commanding premium pricing for their highest tier EPYC server CPUs and Instinct GPUs.
And I guess that's lifting the profitability floor of the entire enterprise.
Exactly.
Honestly, I would argue that margin expansion is the only thing validating their massive spike in operating expenses.
That's a fair point. OpEx was definitely a topic of discussion.
Yeah, because if we pull back to the full year 2025 context, total revenue was $34.6 billion.
Up 34%, yeah.
Right. And they posted record UPS earnings per share of 4.17.
Which is great.
It is great. But their operating expenses hit $3 billion, which is a 42% year-over-year increase.
Yeah, that's a big jump.
Right. Seeing expenses grow faster than revenue, 42% OpEx growth versus 34% revenue growth, usually signals corporate bloat. Or just massive inefficiency.
Under normal circumstances, absolutely, you'd be worried.
So what's the excuse here?
Well, Lisa Su was challenged on this directly by an analyst from Evercore ISI during the Q&A.
Oh, really? What did she say?
Her justification was entirely rooted in the technological roadmap. The semiconductor industry is just currently facing an exponential curve in R&D costs.
Right. Moore's Law getting more expensive.
Exactly. Moving to a 2-nanometer process node, for instance, requires astronomical capital just for the tape-out process.
And the tape-out is basically finalizing the design before it goes to a foundry like TSMC, right?
Yep, the final hurdle. And it's wildly expensive.
But it's not just the silicon design anymore, is it?
No, not at all. A significant portion of that $3 billion OpEx spike is driven by their push into system-level engineering.
Okay, so like the ZT Systems acquisition.
Exactly. They acquired ZT Systems specifically to bring server rack manufacturing and network topology design in-house.
So they aren't just paying chip architects anymore.
Right. They are funding entire teams of thermodynamics engineers, networking specialists, trying to build these liquid-cooled, gigawatt-scale infrastructure solutions.
Wow. So that's the cost of admission if you want to compete at the very top tier of the AI hardware market today.
It really is. You can't just hand a hyperscaler like Microsoft or Meta a tray of GPUs anymore and let them figure out how to wire them together.
Right. You have to deliver the entire rack, pre-configured, optimized, and ready to slot into their data center.
Exactly. So that R&D spend is basically building a structural moat.
That makes a lot of sense.
And additionally, the go-to-market expenses have to scale as they push deeper into traditional enterprise deployments.
Because selling a 10,000 GPU cluster to an aerospace company requires an army of solutions architects.
Right. To hold the client's hand through the software integration process, it's not a self-serve checkout.
Right, right. Which brings us perfectly into the actual story behind the numbers. The specific product segments.
And we have to start with the undisputed king of this earnings call.
The data center. Because the financials are booming, but we need to know what exactly is flying off the shelves.
It's the server CPUs, honestly, the EPYC processors.
Yeah, so the data center segment posted a record $5.3 to $5.4 billion in revenue. Note that there was a slight variance between the executives' remarks there.
Yeah, but roughly in that 5.3, 5.4 range.
Right, which is up 39% year over year. And while the AI accelerators grab all the headlines, the most fascinating dynamic here was the dominance of the traditional x86 server CPU.
The EPYC line. It's having a massive renaissance.
Because there was this pervasive narrative on Wall Street over the last 2 years that GPUs were just going to cannibalize the entire data center budget.
Right, everyone thought the CPU was going to become an afterthought.
But the actual physics and architecture of modern AI workloads have proven that thesis entirely wrong.
Completely wrong. Lisa Su noted that their 5th-gen EPYC processors, codenamed Turin, already account for more than half of their server revenue.
Wow, already more than half.
Yeah, and the 4th-gen is still selling robustly, too.
Okay, so why is this happening? Let me try out an analogy here. Let's compare the modern data center to a high-end commercial kitchen.
Okay, I like it.
The GPUs are the specialized appliances, right?
No.
Like a blazing fast pizza oven. They do one specific intensive thing incredibly well.
Right, making the pizza.
But the CPUs, the EPYC processors, they are the executive chefs organizing the entire flow of the kitchen.
That's actually a great way to put it, because the survival and massive growth of the CPU is entirely tied to how agentic AI actually functions.
Agentic AI. Break that down for us.
So we aren't just talking about large language models generating text in isolation anymore.
Like just asking a chatbot a trivia question.
Right. Enterprise AI acts as an agent. It receives a complex prompt, breaks it down, queries a secure internal database, runs a parallel calculation, interfaces with an external API, and then synthesizes all that data.
And that workflow requires a massive amount of orchestration, the executive chef.
Exactly. The GPUs handle the heavy parallel matrix multiplication, the brute force calculating incredibly efficiently.
But they don't manage the network traffic.
No. They don't handle the secure data retrieval, and they don't coordinate the multi-step logic of an agentic workflow.
That's the CPU's job.
Yes. The EPYC CPUs act as the head nodes. They manage the massive web of PCIe lanes feeding data into the GPUs.
Oh, I see. So as you scale the number of GPUs to handle larger models, you proportionally increase the need for high core count, high bandwidth CPUs to keep those GPUs fed with data.
Precisely. Because if the GPUs are starved of data because the CPU bottlenecked the network, you are burning millions of dollars in idle compute time.
And the hyperscalers absolutely cannot afford that.
No, they can't. And the market data proves it. AMD announced that leading server providers are now offering over 3,000 different solutions powered by 4th and 5th gen EPYC processors.
That is a staggering footprint.
And on the public cloud side, like AWS, Google Cloud, Azure instances powered by AMD grew 50% year over year to nearly 1,600.
So they have essentially solved the supply constraints that dogged them in 2023 and 2024.
Yeah, which is allowing them to aggressively strip legacy by 86 market share away from Intel.
Man, it really is a cash printing machine that forms the bedrock of their entire operation.
It really is. But, the true inflection point for their valuation still lies in the GPU segment, specifically the Instinct series.
Right, the AI accelerators. The call detailed a very aggressive cadence here. We've got the ramping MI350 series transitioning rapidly into the MI400 series.
Which includes the MI450 and the MI45X. It's a bit of an alphabet soup.
It is, yeah. But the underlying technological shift isn't just about faster individual chips, is it?
No, it's about the Helios platform. This goes back to what we were discussing with the ZT Systems acquisition.
Okay, so Helios is their proprietary rack scale architecture.
Right. They are moving toward rack scale solutions, working directly with hardware builders like HPE and Lenovo to deliver fully integrated racks.
So if I'm an investor, what you're saying is AMD isn't just selling individual chips anymore. They are selling entire integrated racks, which means significantly higher revenue per sale.
Exactly. You capture the margin on the entire system, not just the individual silicon components.
And when you are deploying at the scale of that 6 gigawatt OpenAI deal we mentioned at the top, rack scale engineering is mandatory.
It's absolutely mandatory. You cannot cool a gigawatt scale data center with standard air conditioning.
No, definitely not.
And you cannot network tens of thousands of GPUs using legacy switches. The Helios platform allows AMD to dictate the internal networking topology using their advanced Infinity Fabric interconnects.
Which ensures that a GPU in rack A can talk to a GPU in rack Z with microsecond latency.
Exactly. By selling the entire integrated rack, they significantly increase their average selling price, or ASP, per customer engagement.
But hardware is really only half the battle, though. Historically, the massive moat in this sector hasn't been silicon.
Right. It's been NVIDIA's CUDA software stack.
Yeah, developers are trained on it, and the inertia to switch is just massive.
It is. But AMD dedicated a significant portion of this call to their ROCm open source software alternative.
Right. And their strategy seems to rely heavily on the open source community to bridge that gap.
It's basically an asymmetric attack on a proprietary moat.
How so?
Well, instead of trying to force developers into a closed AMD ecosystem, they are integrating ROCm directly at the framework level with platforms like Hugging Face.
Oh, nice.
Yeah, they highlighted achieving day zero support for major new open source models.
So when a new 100 billion parameter open source model drops, developers need to know it will compile and run on an AMD Instinct cluster instantly.
Exactly, without having to write custom optimization scripts.
They also brought up a major strategic partnership with Tata Consultancy services, or TCS, which I found highly calculated.
Yeah, TCS is a big deal here.
Because TCS isn't some flashy tech darling. They are a massive blue-chip consulting firm.
The ones who go into Fortune 500 banks, healthcare networks, automotive manufacturers, and build out their IT infrastructure.
Right. So by partnering with TCS to co-develop enterprise AI blueprints, AMD is essentially embedding their hardware and software into the default recommendations these consultants give to corporate boards.
Exactly. A bank executive doesn't want to choose between ROCm and CUD. They just want TCS to deliver a secure, functioning AI platform.
Right. And if TCS builds that platform on AMD hardware because the economics are superior, AMD bypasses the developer-level CUD loyalty entirely.
It's a very smart backdoor play into the enterprise.
It really is. Now, that enterprise focus transitions us smoothly into the client segment, which is primarily laptops and commercial PCs.
Right, moving away from the massive data centers to what regular people touch every day.
Exactly. So this client segment generated $3.1 billion in revenue, which is up 34% year over year.
And Ryzen CPUs just topped the bestseller list all holiday season.
They did. But, consumer PC sales can be cyclical and, frankly, unexciting. But Lisa Su heavily emphasized the commercial side.
Yeah, she noted over 40% growth in sales to sectors like telecom, financial services, aerospace, and energy.
Over 40% growth. That is not driven by companies simply refreshing broken keyboards.
No, absolutely not. It is entirely driven by the transition to the AI PC.
Specifically powered by the Ryzen AI 400 mobile processors and the Ryzen AI Halo platform. Break that Halo platform down for us.
So they stated that the Halo platform utilizes 128 gigabytes of unified memory, and it can run models with up to 200 billion parameters locally.
Locally, as in on the laptop itself.
Yes. The concept of local AI is the next massive frontier for enterprise computing.
Because we are so used to the cloud computing model, right? You type a prompt, it bounces to a server farm in Virginia, and the answer comes back.
Right, but for major enterprise clients, the cloud is a massive liability.
Really? How so?
It's a liability on three fronts, actually. Latency, cost, and data sovereignty.
Okay, let's talk about data sovereignty first, because that sounds critical for a bank.
It is. If a defense contractor is having an AI assist in analyzing proprietary schematics, or a bank is having an AI parse real-time, highly sensitive customer financial data.
They cannot legally or strategically afford to send that data over the open internet via an API to a third-party cloud provider.
Exactly. It's just a non-starter. And then you have latency. The round-trip time to the cloud makes real-time agentic tasks sluggish.
And the API cost for heavy enterprise usage can just spiral completely out of control.
Right. So by architecting the Ryzen AI Halo platform with a massive 128 gigabyte unified memory pool, AMD allows these companies to load a highly capable 200 billion parameter model directly onto the employee's physical workstation.
So the AI lives on the local silicon. The data never leaves the building.
Never leaves the building. It processes with zero latency, incurs zero ongoing API costs, and complies with the strictest data sovereignty regulations.
That is exactly why commercial IT departments are aggressively buying these machines. They are future-proofing their workforce while locking down their proprietary data.
It's a fundamental shift in where compute happens. It's pushing it from the centralized cloud directly to the decentralized edge.
That's a great way to put it. And speaking of the edge, we should briefly touch on the embedded segment.
Yeah, we can't forget embedded.
Revenue here was somewhat flat at $950 million, up just 3%. However, management highlighted securing $17 billion in new design wins throughout 2025.
And for retail investors who might, gloss over the embedded market because it lacks the flash of AI data centers, that 17 billion figure is incredibly important.
It's the ultimate leading indicator of future embedded revenue, isn't it?
It is, because the embedded market involves supplying chips for highly specialized, long life cycle equipment.
We're talking aerospace avionics, factory automation robotics, 5G telecommunications infrastructure,
and advanced medical imaging machines.
Right. The development cycle for an MRI machine, for instance, it can take 5 to 7 years.
Exactly. So when an engineering team at a medical device company chooses an AMD chip to run their proprietary real-time operating system, that is a design win.
But AMD hasn't recognized the revenue yet, right? because the MRI machine isn't in mass production.
Right. But once that machine launches, the medical company cannot simply swap the chip out for a competitor without entirely re-engineering and recertifying a multi-million-dollar device.
Wow. So the login is incredibly sticky.
Super sticky. Securing $17 billion in design wins over a single year built a massive, highly predictable revenue pipeline that will steadily flow onto the balance sheet throughout the late 2020s and into the 2030s.
It acts as a stabilizing ballast against the more volatile consumer and data center cycles.
And they are absolutely going to need that ballast.
Yeah, they are. Because we have to talk about the gaming segment, which is presenting a severe immediate headwind.
It's a brutal warning they gave for 2026.
Right. On paper, Q4 gaming revenue looked decent at $843 million, which was actually a 50% year-over-year increase.
Yeah, they attributed that to a holiday surge in Radeon GPU sales, bolstered by their FSR4 AI upscaling tech.
But the forward guidance for 2026 was stark. Gene Hu explicitly warned that semi-custom SoC, or system-on-a-chip, revenue for gaming consoles will decline by a significant double-digit percentage.
Yeah, the semi-custom console business is basically a hostage to the hardware life cycles of Sony and Microsoft.
Because AMD designs and supplies the integrated chips that power the PlayStation 5 and the Xbox Series X.
Right. Both of those consoles launched in late 2020, so we are currently entering year 7 of that hardware generation.
And the economics of the console market follow a very rigid bell curve, don't they?
Very rigid. The early years are massive revenue drivers as early adopters upgrade. By year 3 and 4, you hit peak saturation.
But by year 7, the market is entirely tapped out. Anyone who is going to buy a PS5 already owns one.
Exactly. And the hardcore gamers are now withholding their cash, waiting for the inevitable announcements of the PlayStation 6 or the next generation Xbox.
Lisa Su confirmed that development for the next-gen Xbox is progressing well on AMD silicon, but realistically, those consoles are not launching until late 2027 or 2028.
Right. Therefore, 2026 is a dead zone. Sony and Microsoft are slashing their chip orders because hardware sales have plummeted.
So this entire segment, which is historically a $1 billion a quarter business for AMD, is going to act as a heavy anchor, dragging down their overall top-line growth metrics for at least the next 4 to 6 quarters.
It is, which makes navigating management's forward guidance for 2026 particularly tricky for you as an investor.
Yeah, we really have to parse out the explosive AI growth from the collapsing console cycle.
So let's look at the Q1 2026 outlook.
Okay, so Gene Hu guided for approximately $9.8 billion in revenue, plus or minus $300 million.
Which represents a 32% year-over-year increase.
But importantly, it is a 5% sequential decline from the $10.3 billion they just posted in Q4.
Right. And a retail investor simply glancing at a sequential revenue drop might panic, assuming the AI supercycle has suddenly stalled.
But you're saying that's not the case?
Not at all. Analyzing this within the context of the broader semiconductor industry reveals that a mere 5% sequential drop in Q1 is actually an incredible display of strength.
Wait, really? A drop is a display of strength?
Yes, because of the heavy seasonality in the client PC market.
Ah, right. Q4 is driven by holiday spending and end-of-year corporate IT budget flushes.
Exactly. Q1 historically experiences a massive double-digit percentage drop-off in laptop and consumer PC sales. It happens every single year.
So the fact that AMD's total revenue is only dipping 5% means that the sequential growth in data center CPU and GPU deployments is running so hot that it's almost entirely absorbing a multi-billion-dollar seasonal cratering in their consumer divisions.
You nailed it. It's actually a massive win masked as a slight decline.
That is fascinating context. But there is a specific nuance in that Q1 guidance that we have to evaluate impartially, and that is the impact of geopolitical export controls.
Specifically regarding China, this is a very sensitive topic.
Yeah. The earnings transcript revealed that AMD recognized $390 million in sales of their MI308 accelerators to Chinese clients in Q4.
And they are projecting an additional $100 million in Q1.
Right. However, management explicitly zeroed out any future China revenue beyond Q1 in their forward models.
Not at all.
So I have to push back here. What does this all mean for the reliability of their forward-looking numbers?
Well, we have to view this entirely through the lens of regulatory compliance and risk management. The U.S. government maintains an incredibly strict entity list.
Right. To manage what tech gets exported where.
Exactly. They enforce complex performance density thresholds that dictate what tier of silicon can be exported to specific countries. The goal is to maintain technological superiority in AI training capabilities.
So AMD had to secure highly specific export licenses from the administration to ship those legacy MI308 chips.
Yes, essentially to clear out a backlog of orders from early 2025.
Okay, but those licenses are temporary, right? And specific to older architectures.
Exactly. AMD has obviously submitted license requests to export their newer MI320 and MI325 architectures, but the regulatory environment is volatile. Approval is never guaranteed.
So if Jean Hu were to model hundreds of millions of dollars of future China sales into her 2026 guidance without having those licenses physically in hand, she would be exposing the company and its shareholders to massive risk.
Massive missing earnings risk if the geopolitical winds shift. So it's essentially the ultimate exercise in corporate sandbagging.
Interesting. So by completely removing the Chinese market from their baseline financial projections for the rest of 2026, they are de-risking the forecast.
Right. If the export licenses are denied, the company still hits its stated targets.
If the licenses are miraculously approved, that revenue flows to the bottom line as pure upside surprise.
Exactly. It's a defensive posture that protects management's credibility with Wall Street.
And preserving that credibility is vital when you're promising the kind of long-term structural targets that Lisa Su reiterated on this call.
Oh, yeah. She pointed back to their financial analyst day projections, targeting a compound annual growth rate, or CAGR, of greater than 35% for revenue over the next 3 to 5 years.
Over 35% CAGR. That's aggressive.
And alongside that, annual earnings per share scaling beyond $20 in their strategic time frame.
Okay, hitting $20 in EPS when they just posted a record 4.17 in 2025 requires an absolute execution masterclass.
It does, not just in sales volume, but in expanding the gross margin over multiple generations of cutting-edge silicon.
How exactly do they plan to do that?
Well, that margin expansion is intrinsically linked to the physics of semiconductor fabrication. When AMD launches the upcoming MI500 series on a cutting-edge 2-nanometer process node, the initial gross margins will naturally be lower.
Because squeezing billions of transistors onto a 2-nanometer wafer is incredibly difficult, I'd imagine.
Very difficult. The initial defect densities are high, meaning the foundry yields fewer usable chips per wafer.
And the testing and validation processes take longer. Plus, the fixed costs of the tape-out are spread across a smaller initial production run.
Right, but as the foundry masters the 2-nanometer process over the subsequent quarters, yields improve drastically. Fewer chips are thrown away.
So the manufacturing efficiency scales up.
Yes. And because the MI500 will command a massive price premium due to its performance, the gross margin profile of that specific architecture expands significantly over its life cycle.
Oh, I see. So they are layering these architectures, MI350 to 400 to 500, so that the maturing, high-margin, older chips fund the expensive ramp of the newer chips.
It is a phenomenal financial model if they can maintain the cadence without any major silicon bugs or supply chain disruptions.
All right, waded through a ton here. The financials, the underlying technology shifts, the geopolitical guidance. It is time to synthesize all of this into the bottom line.
The verdict?
Yes, the actionable verdicts. For the retail investor sitting at home, holding AMD stock or considering initiating a position, what is the takeaway based on this immense data dump?
The consensus posture here has to remain structurally bullish, but it requires a much more nuanced understanding of the timeline than the market might appreciate right now.
Okay, so let's outline the bull case first. What are the elements working in their favor?
The most vital takeaway from this call is that AMD is no longer fighting a defensive war of attrition in the data center. The supply constraints that choke them in the past are gone.
So their ability to fulfill massive x86 EPYC server orders means they are perfectly positioned to capture the enterprise infrastructure upgrade cycle.
Right. EPYC is their reliable cache engine. But the ultimate catalyst for the bull case is the successful execution of the MI450 series ramp in the second half of 2026.
Ah, yes. The superclusters.
Exactly. Transitioning from selling individual AI accelerators to deploying fully integrated liquid-cooled Helios rack-scale solutions fundamentally changes their total addressable market.
And securing gigawatt-scale, multi-generation deals with the likes of OpenAI really proves that the largest hyperscalers in the world view AMD as a top-tier, viable alternative to NVIDIA.
Right, for the most complex AI training workloads out there.
Okay, so that is the blue sky scenario. But an objective retail investor must weigh that against a very real bear case forming in the short term.
Cautionary elements are definitely present. We already detailed the collapse of the gaming segment.
Right, which will act as a multi-$100 million anchor on quarterly growth throughout 2026.
But there is a secondary headwind brewing in the broader PC market too, driven by the AI boom itself.
Yeah, you're talking about the Q&A segment where an analyst from TD Cowen brought up inflationary pressures on commodity pricing.
Specifically high bandwidth memory, or HBM.
Right, because the explosive demand for AI data center GPUs is basically sucking up almost the entire global supply of HBM.
It is, and that scarcity is driving memory prices through the roof. PC manufacturers have to absorb those costs, which makes traditional laptops and desktops more expensive to build and sell.
So Lisa Su had to acknowledge that the total addressable market for traditional consumer PCs might actually contract slightly in 2026 due to these inflationary pressures.
Right. So the bear argument is that AMD might be fighting a two-front war here. A shrinking total PC market constrained by memory costs and a dead console cycle.
If you are an investor, you have to reconcile those legacy headwinds against the massive AI growth. So translate this into an actionable strategy.
If you hold this stock, you must view 2026 as a tale of two distinct halves.
Okay, explain the first half.
The first half of the year is going to be defensive. Management will be relying heavily on the unglamorous steady cash flow of EPYC server CPUs and commercial Ryzen client sales to offset the massive seasonal slumps and the gaming cliff.
So the stock might experience significant volatility as the market digests sluggish top-line growth numbers in Q1 and Q2.
Most likely, yes. But the second half of 2026 is pure offense. The entire valuation model hinges on the seamless rollout of the MI350 AI superclusters.
Okay, so if you are managing your position, what is the primary metric you need to monitor in upcoming earnings calls?
It isn't just raw GPU revenue, it is their execution on these rack-scale deployments. If they report supply chain hiccups with the Helios racks, or if the ZT systems integration falters and they delay shipments, the bull thesis will be severely punished.
Conversely, if they hit their deployment targets for these gigawatt-scale enterprise clients without margin degradation, that path to a $20 EPS becomes a mathematical reality.
It's basically a high-wire active execution at an unprecedented scale.
It truly is. To bring this all together, the core narrative of the 2025 earnings call is that AMD is orchestrating one of the most complex pivots in modern corporate history.
Moving from a traditional chip maker to an end-to-end AI infrastructure behemoth.
Exactly. They are dominating the traditional server room with EPYC head nodes. They're pushing localized 200 billion parameter AI onto enterprise desk with Ryzen Helios, and they're building gigawatt-scale GPU clusters.
All while aggressively navigating international export restrictions and a collapsing console cycle.
And they are generating billions in free cash flow to fund their own aggressive capital expenditures, proving they have the balance sheet to weather the legacy headwinds while financing the AI future.
It's an incredible story to watch unfold.
It is. But before we sign off, I want to return to that opening statistic and leave you with a final thought to mull over.
Oh, right, the 6 gigawatts.
Yes. We are dissecting this company's ability to manufacture enough silicon, improve their ROCm software, and capture market share.
Which are all valid points.
But when top-tier tech firms are signing deals for 6 gigawatts of power just to switch these server racks on, the fundamental constraints of the industry are shifting.
The silicon is no longer the hardest part of the equation.
Exactly. As an investor looking at a multi-year supercycle, you have to ask yourself, are we rapidly approaching a threshold where the ultimate bottleneck for artificial intelligence growth isn't TSMC's wafer capacity, or AMD's chip design, or NVIDIA's software moat?
Is it the power grid?
Is the ceiling for this entire industry going to be the literal physical capacity of the global electrical grid to generate, transmit, and cool the massive amounts of energy required to sustain it?
It's a sobering thought. The smartest silicon in the world is just very expensive sand if the local utility company can't give you enough power to turn the cooling pumps on.
Right. The AI arms race is no longer just a compute race. It is a heavy infrastructure and power generation race. We have moved way beyond the simple binary mechanics of a spreadsheet, beat or miss.
We are analyzing the physical limits of global infrastructure now.
We really are. Thank you for joining us on this TalkTickers edition of the Deep Dive. Keep your eyes on those rack-scale execution metrics. Look beyond the headline margins and stay curious.